presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for October the 27th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, don't forget to click on the subscribe button so whenever I post an update, you will be notified. If you want to listen to the long version of this YouTube update, where Javed and I talk about it in much more detail, you can go to compac.com, click on Insights, and you can also listen to the podcast. Let's start with the numbers. Last week, beautiful week in the markets, up 1.93% for the S&P, up 2.25% for the Dow. We saw the NASDAQ up 1.31%, the Russell Small Cap up 2.51%. So a wonderful week overall for the markets. Year to date, S&P is up nearly 16.68%, Dow's up 12.5%, and the NASDAQ is up again nearly 21%. So a wonderful, wonderful year so far in the markets. Technology led the way last week, and this week we are very heavy on earnings, so that's really going to, 5 of the top of the Mag 7 are going to report this week, so that should give the market a boost. The earnings are expected to be good overall and continuing to move up. We're looking at oil, basically flat, not much going on there, still about $10 lower than where it was at the beginning of the year. Interest rates flat for the week. There is the meeting expected this week. We went so still no change there, but there is expectation this week that we are going to get another Fed interest rate reduction of 25 basis points. But they're also talking about cutting back on QT, that's quantitative tightening. That is the amount of bonds that they buy every week. If they decide to cut back on that or expand that, that would definitely be something that we could see more bonds being bought, and that brings the market back up also. So we'll have to wait and see what the Fed says more than what is expected. There's a high probability that they are going to cut interest rates by 25 basis points now, especially with the inflation number coming out a little bit cooler than expected, and that should be a positive. And there's another interest rate expected at after this meeting in December, which is the next FOMC meeting, another 25 basis points. And that is giving the market a boost right now overall. Where are the earnings coming from? The earnings per share growth that we're seeing on the S&P, 57% of it is being contributed by the Mag 7, the high-tech companies. And 21% of the growth of earnings is coming from technology. The rest is financials, which are also up nicely, up 44% for the contribution to the S&P. So these two sectors, high-tech and financials, are the two that are giving the biggest boost, biggest contribution to earnings per share, and that is what is driving the market. As you've heard me say for 30 years, earnings per share, how much a company makes, the more money a company makes, the more valuable their stocks are. And that's where we're seeing the growth, and that's why we're seeing most of the gains in the stock market coming from technology and financials. Our headline CPI came in at 3% year over year, which is lower than expected, which is a good sign overall. Manufacturing PMI above 50, that means it's expanding. Services PMI 55, which is growth. Very, very nice numbers there. So the economy is going strong overall. This week, not a lot of economic data. Government still remains shut down. And sooner or later, that is going to start to have an impact on the economy. It'll take away, next week, the SNAP contribution of the government gives out food stamps. That's basically what what the SNAP is. That will not have money to be given out. So we will have to wait and see how this economic fallout, if it starts to really slow down the economy and starts to hurt the economy. So far, there are isolated sectors of the economy that are being hurt a little bit, but not overall. So sooner or later, once we get this thing resolved, which it will be sooner or later, I think that'll be a positive for the market. Interest rate reduction is a positive. And the biggest driver is earnings per share for the S&P. They continue to come out better than expected. Looking at the technicals, market gapped up today. There's a little space between Friday's close and today's open, and that is a gap, as it's called. Support now 67.05, which is the 20-day moving average, then 66.03, which is the 50-day moving average right there. So we'll see exactly how this comes out overall. So really a nice move there for the market. Continues to move higher. This is still a third wave. You'll get a fourth wave pullback somewhere. On the weeklies, again, we gapped up today. Support 65, 64, 67, 20-week, and then 6100 is about the 50-week moving average. Also a gap up today on the Nasdaq daily chart, support at 22.8. We're at 23.6 today. Just moves higher. Everything market is moving, just continues to move. Economy continues to grow. Interest rates are expected to come down. Trade deal with China seems like the negotiations are going well. We'll see the president meet the president of China in the next couple of days. That should give us some idea of where we're headed with that. There was some breakdown in talks with Canada, which I think will sooner or later get resolved one way or the other. The three major deals, Mexico, Canada, and China, and Canada and Mexico are part of NAFTA, so not a lot of things are outside of NAFTA that can be tariffed. So it's really China, and China seems to want to make a deal. Seems like we want to make a deal with China. So it'll come around, but there will be some tariffs, and we are seeing tariff revenue, which can be a tremendous amount of money that'll be coming into the Treasury. What are we going to do with it? Now, there's talk that there might be a tax cut, one-time tax payment to the public, or we might see a deficit reduction where the money is applied to bring down the deficit, and that could be a very, very big positive. NASDAQ weeklies also gapped up this week. Market continues to move higher. As I said, once the technicals turned up, these dots right here, as dots are below the market, this is the market right here that we're seeing. The dots are below the market. That is positive. It turned up in April or May, and we've been up ever since. So once it turns up, as I've said, they usually last for a long period of time, and we've seen since April the dots are positive. They're below the market. This is the market. These are the dots right here, and as long as the dot plot is below the market, it's a positive phase. Interest rates continue to drift lower as the Fed is expected to cut rates. We are down to about 4% now. Support is right about here at 3.9. We did get close to that, somewhere around 3.95 last week. Today we're at just about 4%. Looking at the gold market, the long-awaited correction has started in gold, a pullback right here. This is GLD, seems like a fourth wave pullback. Major support is 347. We're at 367 today in the GLD. That's the ETF for gold, and we're below the 20-day. So right around here somewhere to about here somewhere could be an opportunity to take a look at gold if you're not in it and want gold. The high yield market has definitely turned positive. We went below the 50-day right here, which was starting to get negative a little bit, but now we're solidly above the 80.83, which is the 50-day moving average. We're 81.31. So overall, the market seems like it wants to move higher. We've had a lot of negative news in the market. We heard the breakdown of talks with Russia and Ukraine. We heard about new sanctions on Russia. We heard about the government shutdown. We heard about all of these other things, which should be negative for the market. Market sort of shrugged it off. And as you've heard me say over the years, when you get bad news in the market and the market goes up, watch out for that market on the upside. And that's what we continue to do. Sooner or later, we'll get a correction. But if the market goes up 20% and corrects 10%, and you've been waiting to buy the market because I can't buy it here, it's at an all-time high, and I've shown you charts, buying it at an all-time high 12 months later is better than buying it on a correction. Because if you miss 20% and get a correction of 5 or 7% and then buy it, you're still behind 13%. So trying to time the market is an exercise in futility. Time in the market is what makes the difference. Those are my thoughts. Those are my observations. Again, if you'd like to get help on your portfolio, send us an email at invest@compact.com or give me a call at 800-388-9700, and we will be more than happy to sit down with you, develop a plan for you, and show you how to get from where you are now to where you want to go financially. Those are my thoughts. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.